Tesla stock has fallen more than 30% since the beginning of the year, but it's also made some gains. Considering the current market performance of the stock, as well as its past records, can Tesla stock be rated a buy, sell, or hold for the future? Hey everyone, and welcome back to Everything Tesla Stock. Tesla has been in a series of upward and downward trends, currently trading below $300 at the time of this recording. The EV company shares have not been doing so well in the past weeks, but several analysts still seem to remain bullish on the stock despite the recent dips. And here is, once again, another strong positive rating on the stock. Goldman Sachs analyst Mark Delaney recently shared his optimism about the stock performance, advising investors to buy the company's shares. According to the stock analysis, Tesla has the potential for long-term growth based on these reasons. Why has this guy then said this about Tesla? Find out more in this video. Before we start, if you like this type of content, don't forget to hit the like button, subscribe, and turn on notifications to keep up to date on everything going on with Tesla. After a meeting with Tesla's head of investor relations, Martin Viecha, Delaney shared some reasons as to why he believes that there is more upside to Tesla than most people see. The analysis rated Tesla as a buy, setting a price target for the stock at $333.33 per share. Delaney is a long-time Tesla bull who believes that the EV company has so much more to offer both now and in the future. Tesla is still keen on its mission to accelerate the transition to sustainable energy and is therefore focused on improving production for not only its EVs, but other products too. The automaker is committed to increasing its car demands while lowering costs, and making electric vehicles more affordable across its markets. So moving on to the Goldman Sachs analysis, why then does Delaney think that Tesla investors could make massive profits on their investment in the coming years? Be sure to stay on this video to find out. On the 11th of August, the United States President announced the Inflation Reduction Act, the IRA, into law. This is aimed at bringing in regulations that are going to provide relief on the harsh effects of inflation in the country, as it is focused on solving the problems of inflation by lowering prices and deficits, and investing in domestic energy production while promoting clean energy. It also allows consumers to receive credit for electric vehicles placed in service until the end of 2032. According to Delaware, Tesla will benefit massively from this law, and this is very likely to happen since Tesla is focused on improving sustainable energy. Tesla is the most integrated automaker in terms of car production, as well as battery, software, and overall service. The automaker can adjust raw material supply chains for its batteries quicker than other electric car makers. Delaney stated that although it is too soon to say what impact the Inflation Reduction Act is going to have for Tesla since it's still very much dependent on guidance from the government, the carmaker has a good chance of scaling up car sales as a result. He added that Tesla has more local manufacturing power than average, and this is going to be a big advantage for Tesla to potentially qualify for at least partial credits on some of its vehicles over time. Tesla already has high demand for its cars, as Elon Musk has stated, and this is obvious judging by the number of car deliveries that the company's been making in the past years. With this expected credits on electric vehicles, Tesla's car demand will likely increase, leading to higher gross profit and operating margin. Tesla's continued to increase its car sales despite the plunging market conditions. The carmaker sold 47,629 cars in August, which is about 11% more than its car sales in July. Likewise, Tesla increased its market share in the US from 2.1% in 2021 to 4.1% this year, and in Australia, it outsold popular car maker Toyota Camry to become the fourth best-selling vehicle in the country in August. This shows that the car company sales have been on an upward trend in the past few months, and may likely continue on this trend in the next months as well. Delaney predicts a 22% increase in Tesla stock, and that is achievable since the company is constantly growing in most of its markets. Tesla is building and selling more cars than ever, and it's doing it quicker in China, where it sold 77,000 units of its Model 3 and Model Y in August. The stock analysis also added that since Tesla is focused on lowering costs, it stands a good chance of seeing a surge in its stock price in the future. Speaking on Tesla's ability to reduce cost, Delaney cited that Tesla's automotive cost of goods sold per vehicle fell to about $36,000 in 2021 from over $70,000 in 2017. He added that while this metric increased in the second quarter of the year as a result of factory shutdowns, input cost pressure and factory startup costs, Tesla can still reduce its cost of goods sold per car. He attributed this to Tesla ramping up production at its Berlin and Austin factories, as well as battery improvements. Tesla is focused on lowering costs through manufacturing efficiency. The car company is building more factories to increase production outputs. Although Tesla may have fewer factories than some of its competitors, this could be an advantage in some ways, since the automaker can build larger facilities and focus on improving them. Likewise, Tesla has fewer car models, which allows it to provide the best technology for its car users. And this is a good thing for the car company and its investors. Some experts believe that Tesla's market challenges are only temporary, seeing as the automaker is also making moves to overcome these drawbacks, like increasing its car prices and ramping up battery production. Tesla is committed to growing unit sales to 50% over time and may cross the milestone if it successfully boosts car sales amidst the production hurdles. Do you think Tesla can maintain that 50% growth over the coming years? Let us know down below. According to Delaney, Tesla believes that consumers will increasingly move towards electric vehicles just as they appreciate similar modern technologies like smartphones. This is quite evident considering the high demand for electric vehicles and the several government policies that support the use of these cars. If Tesla does then continue to record an increase in its car supply, it could potentially boost profits. However, Delaney stated that the EV industry may record lower car supply over the intermediate term due to less batteries and components available. This is not the first time that the ANALYST is raising his price target on the stock. Earlier this year, Delaney increased his price target for Tesla from $1,125 to $1,200 pre-split, rating the stock as a buy. He also named Tesla as a top pick for 2022. Delaney did the same thing back in 2016 when he advised Tesla investors to go in on the company's stock, upgrading his recommendation on the stock from a hold to a buy. Delaney is not the only analyst who's bullish on the automaker's stock. Wolfe research analyst Rod Latch also recently gave an outperform rating to Tesla and increased the target price from $317 to $360 per share. He also raised the company's penetration estimates for the United States from 10 to 20%, owing to the Inflation Reduction Act in the country. Likewise, Garrett Nelson, Vice President and Senior Equity Analyst of CFRA Research, recently in June announced that Tesla is a strong buy, giving it a price target of $1,200, priced on its long-term growth potential per share. In the same way, most Wall Street analysts remain optimistic that Tesla still has long-term growth potential despite the dips, although some argue that the car maker will continue to be dominant in the playing field when it comes to fast-growing electric vehicles in the market. Well, we'll have to see. Tesla is no doubt an incredible company, so it's not surprising that it's had these bullish predictions. Delaney believes that given Tesla's leadership position in the EV industry and its focus on clear transportation, it is well positioned to capitalize on a long-term shift to electric vehicles. He added that Tesla can expand margins in the intermediate term by ramping up production across its gigafactories and in the long term increase its mix of software revenue. However, this is not a guarantee that Tesla will eventually reach the price estimate by Delaney, as this is just his opinion on the stock performance. Investing in any kind of stock then should be based on logic and numbers. Also, although investors may be more concerned about the Inflation Reduction Act promoting clean energy and allowing EV customers to receive credit, it is important to know that there are also some downsides to it. For the government to reduce inflation, it will take measures to control spending, which will consequently increase interest rates, causing the share price to go down. This isn't a good sign for Tesla, and so investors may want to look into this possibility. But if Tesla does seem like the right investment stock for you, then it might be a good time to invest in the car company. What's your take on Mark Delaney's predictions on Tesla? And do you think that Tesla stock is really a good buy at the moment despite the recent dips? Let us know down below. If you want to know more about Tesla and what it's been up to in the next few days, then you can go ahead and click on this next video on your screen. See you there.